Nervous about the economy? Well, you're not alone. But what should you do about it? How best to protect yourself when things look dicey? Time for the bottom line, those unmasked defenders of your money. Patty Croft is an economic analyst and former senior banker. Jim Stanford is an economist with Unifor. Preet Banerjee is a freelance broadcaster and personal finance advisor. And Amanda Lang is our senior business correspondent. Their thoughts in a moment, but first, some hard numbers. And some of these numbers are hard to look at. Great job growth had been expected last year. It didn't happen. 185,700 new jobs were created, bringing the unemployment rate down from 7.2 to 6.8%. Decent, but far from great. Household debt continues to rise on all fronts. Credit card, lines of credit, and mortgage, the triple whammy. Meanwhile, incomes remain stagnant, which translates into a widening debt-to-income ratio. And as a backdrop, these three horsemen of the, well, it's not everyone's apocalypse, but you get the idea. The TSX and Dow, down. The dollar keeps dropping, and oil has tanked. So 2015 is off to quite the start. What does it mean for us? What should we do? How does it all affect our lives, from kids to homes to retirement? Enough with the questions. Let's get some answers. All right, let's think pocketbook issues here. What's the greatest risk to our personal finances right now, Patty?
I think it's a lack of personal savings. I think we continue to have a savings crisis in Canada. We are a nation of consumers and not savers. And I'm not talking about retirement savings per se. What I'm talking about is the most basic of savings, and that's the emergency fund, the what if. What if I lose my job? I have an unexpected expense. Can I cover that? And I think for many Canadians, the answer is no.
Jim?
I go back a bit behind that. In order to have some savings, you've got to have some income in the first place. And for most Canadians, the dominant determinant of their financial well-being is if they can find and keep a job. You put up the numbers at the beginning, Peter, about our lousy performance last year. Compare that to the Americans. They created 3 million jobs in 1 year. So it was a lousy year for us. If things get any worse on the labor market front, then we're going to have some real problems.
I kind of echo what Patty says, but I'm going to take the long view. So personal finance is as much about the short view as it is the long view. And as a society, we're anchored on age 65 as being the retirement date. And it's been like that for as long as people can remember, but people are living longer. So retirement is being longer. And we're also launching later. So people are in school for longer than they have been in the past. They've got more debt, and they've also paying more for houses. So it takes longer to even start on that runway to start saving and thinking about retirement. And so if we want to consist on maintain 65 as a retirement age, then two things can have to happen. You have to save more money, or you have to abandon the idea that 65 is where we have to retire at.
Amanda?
I'm going to agree that household debt is actually the big risk here. And that is because, I mean, I'll take Jim's point that incomes have been a problem. We haven't seen the great growth you'd want to see. But we've really seen savings deteriorate. I mean, it's been remarkable. We've stopped saving, which means we're consuming more than we can afford to, which is a pretty simple equation. If you make X, you can't spend X plus 1. And when we are in Canada, we need to get that. We need to get a grip on it. At
times like this, who is most at risk, Patty?
I think here in early 2015, it's a story of regions and a story of sectors. So the regions at risk are Alberta, Saskatchewan, Newfoundland, Labrador, and the sector is the oil patch. And of course, we're already seeing layoffs, which is a grave concern, but it's also the spin-off effect. Lots of stories about Fort McMurray, boomtown to ghost town. So it's not just the jobs in the oil sector, it's the ancillary jobs, it's the hotel workers, the fast food workers that are now also at risk.
Jim?
I break it down according to class, really, more than sector or region. There's a lot of middle and lower income Canadians who still haven't even recovered from the last recession. They got no personal financial cushion to fall back on if they lose their job. And unfortunately, we don't have much of a social safety net for them. In Canada now, if you're unemployed, if you lose your job, you've only got a 40% chance of collecting any employment insurance benefits at all. So I think those are the Canadians who are really in a precarious situation.
Now, a lot of oil talk today for a lot of good reasons, but one of the upsides of this crash in the oil price is the fact that we're saving money at the pump. I gassed up the other day for 87.9 a litre, which in Ontario is a big deal. What should we be doing with that savings? Are we saving it, or we're clearly not saving it? At least Patty's saying we're not. Save it or spend it? What's the right thing to do here?
So it's interesting because economists are actually looking at this, and typically what the answer would be classically is we want people to spend it, right? Spending money gets money moving through the economy, and that creates wealth. But we've identified this issue that we are in the hole as a nation. And so economists actually, when they're making the calculation about what Canadians will do, are suggesting we'll save half and we'll spend half. I don't know whether it'll be that straightforward. Saving some of it or paying down your debt, which is the reality, with the little extra money you may have, is probably the right thing to do, but it doesn't juice the economy. So it is a little bit of a double-edged sword. The right thing to do may not help everybody else.
You know, let's assume you have something to save. You're the personal finances expert here. Tell me, what plans should I be looking at? Because there are incentives from government to try and save money. What are the ones that are the best to use to save?
To make it simple, I would say the tax-free savings account should be the default. Now, if you have a higher income tax bracket, then the RSP starts to look more attractive. The thing with the RSP that people may not realize is that it's a giant tax deferral mechanism. So while you save some tax when you make a contribution, the piper has to get paid. So ultimately, when you take the money out, you get taxed. So if you have a reasonable expectation that your tax bracket is going to drop between the time that you contribute and when you take it out, then an RSP looks more attractive. But I do want to say that there is a caveat. If you're a low-income Canadian and you're thinking about using RSP because people have been conditioned to RSPs for savings, it's actually one of the worst ways to save for retirement because you don't get much of a tax savings up front. But when you take it out, it affects your income-tested benefits, which can be clawed back at 50 cents on the dollar. So you might get a 20% tax savings putting the money in, but effectively pay 75% on the way out. So the people who can least afford to be penalized by those tax incentives are losing out.
Penny?
I actually don't like tax-free savings account because I think too many people are using them like an ATM. You put the money in, you take it out, and net, you're not building those savings. But I think there's another acronym that we should consider, and that's RESPs, Retirement Education Savings Plans. If you have a kid, a grandkid, a niece, or a nephew, give them money to put into those plans, because I think the best gift you could give a kid is to graduate from college or university with less debt. So I urge people to look at that vehicle.
You know, a lot of people, whether they know it or not, have funds set aside that are working for them, pension funds from their company or whatever it may be. How tied are the average funds to oil right now, to energy-related stocks that have been tumbling? So what is the danger in there?
In Canada, Peter, unfortunately, they're very tied. And I know Preet's spoken of this on a previous show, this kind of home market bias that we have. First of all, Canadians have kept a large share of their investments at home in Canada. But then on top of that, our stock market and our financial institutions are way overweighted in the oil sector. It reflects the underdevelopment of our business community in other sectors. So
when you say overweighted,
at peak,
how much? At
peak, for example, a third of the value of the Toronto Stock Exchange was all wrapped up with oil and some other resources. Yet oil is only 3% of our GDP, and it's because a lot of the other sectors either aren't publicly traded companies, so they're not on the stock market, or they're subsidiaries of foreign companies, so they're not traded in Canada. So our domestic stock market, to the extent that it matters, and I'm always skeptical of that, was very risk concentrated in the oil sector, and that's going to hurt right now.
We should make a distinction, though, between pension funds and the funds you might own in a mutual fund.
Right.
Most Canadians all Canadians are exposed to the Canada Pension Plan. It's very diversified. It's not overly exposed to anything. The Ontario Teachers Pension Plan, not overly exposed. These are huge funds that have the benefit of a global market. If you are investing in mutual funds, you need to choose. If you've got a big cap Canadian mutual fund, you're overly exposed to energy, no question, because for all the reasons Jim described. So that's in your control, but the funds that are outside of your control are fairly well diversified away from energy.
How worried should we be about this, Patty?
I wouldn't be that worried for the reason that Amanda cited, because right now energy is about 20% of the TSX. So if you have all your money in the Canadian stock market in an ETF, which is a passive investment, yes, you're taking a hit. But most people in their pension money, it's very diversified. And the other factor is pensions have a long-term time horizon, a 50 to 100-year time horizon. So yes, right now all focus is on oil, but I'm not worried about those pension plans being able to pay the pension promise just because we have a 50% drop in the price of oil.
Let's talk debt levels for a minute. We mentioned it in that setup pack, and we've been warning, not we, but the country has been warning, whether it was back to Mark Carney days, Jim Flaherty days, warning about debt levels. How much debt is too much debt, Preet?
Well, that number that gets bandied about a lot, the debt-to-income ratio average for Canadians is, what, 163%. But for a young Canadian, all your expenses are front-end loaded in life, but your income is back-end loaded. So borrowing is a way of life for young Canadians. And so if they do the math, they might find out that they have a debt-to-income ratio of 350%. That might actually be okay. Whereas a senior citizen, someone who's 65 and approaching retirement, they should have a debt-to-income ratio of 0. So you have to kind of balance it where you are in life. But what I would say is that as a mindset, people need to start thinking that, we need to borrow money only for appreciating assets and not for depreciating assets. And usually the pushback I get from that is, well, how do I buy a car? I can't imagine not having car payments. And the answer is, either take the bus or look for a cheaper car.
The other thing we've talked about often on this program, it seems ever since our very first panel, we've talked about house prices and the fact that at any minute now it was going to go boom. Well, it still hasn't got boom, but we keep getting the warnings, and the warnings are getting louder and louder. How are we supposed to look at this right now, the housing issue?
I think house prices are one of the wild cards right now. I agree with our consensus so far that the decline in the price of the oil, the decline in the TSX themselves are not a reason to panic. I'm more worried that a sharp decline in those could expose some underlying financial fragility. One of them would be in banks that are exposed to defaults in the oil patch in Alberta that we know are coming. Another would be the house price issue. I would expect housing prices to decline in Alberta, certainly, and perhaps Saskatchewan this year. Is that going to spill over into some of the other overheated markets, Toronto and Vancouver in particular, or not? We can't answer that. We've been wrong 5 times in a row when you've asked us.
But the warnings about house prices came long before the drop in oil.
And they're more significant. The judgment from the Bank of Canada, from international experts, is in fact that the Canadian market could be 50% overvalued, which is a lot. And what's holding it up at this point is people's continued willingness to pay. If they suddenly think the prices are going to fall, then they can fall as a self-fulfilling prophecy, and they can fall pretty quickly.
But real estate is local, so I don't think we should expect what's happening in Alberta to impact Toronto and Vancouver, because I think we have a 2-tiered market in Canada, and it's about Toronto and Vancouver versus everything else. Because, but even if we look at Toronto, in 2014, prices were up 8%, yet the condominium vacancy rate went down to 1.2%. There's no sign of overbuilding. All indications are both Toronto and Vancouver are actually in balance, which is absolutely remarkable.
It's amazing to say there's no sign of overbuilding. When you look out the window at the cranes, it's still pushing up condos.
People are buying them.
I've said this before, but it really bears repeating. People have come to think of homes as something that will make them money. Historically, houses do not make you money. They're a store of value. They rise with inflation. So you won't lose money. It's actually a fairly decent way to save if that's a savings vehicle. The idea that you'll make 10, 20, 40% on your home, it happens in bubbles. And if you time that wrong, you can lose a lot. People should get out of the business of buying a house because they're going to make money on it. You won't.
They should buy a house because they're going to live in it
want to
and
enjoy
raise
it.
their kids in it.
That's right.
All right, time for a quick break. But when we come back, this question. What's your bottom line #1 tip for weathering a financial storm? And welcome back to The Bottom Line. Patty, Jim, Preet, and Amanda all at the table tonight. #1 tip from you, the insiders, for turbulent times and dealing with turbulent times. Patty, what's yours?
Well, in terms of turbulent times, I don't think that's what we're in right now. I think that 2008 was a storm. I think this is a passing shower. So my advice is to relax, to have a long-term perspective in terms of your savings, and also to be diversified. I think that's very, very important. Yes, we have our challenges in Canada, but don't forget this drop in oil is a huge benefit to billions of people around the world, in China, in Asia, in Japan, in Europe, in the United States. So there's a benefit to be had as well.
You're obviously not living in Alberta today.
No.
Jim?
I don't have a happy answer to your question, Peter, but I think it's a realistic one. And my insider tip is you cannot protect yourself against the turbulence that's coming to the extent that it is a turbulent year through your investment choices or your personal financial planning. Everyone's financial well-being depends first and foremost on macroeconomic developments, the labor market, how the overall economy is going, our productivity, how we distribute income, and those are all collective macroeconomic phenomena. So as an individual, maybe I agree with Patty, but via a different route. Relax. Your own choices are not going to fundamentally alter what happens. You just kind of have to hope the overall train keeps going in the right direction.
Preet, give me a tip.
Sure. Yeah. Well, 1/3 of Canadians hold about 3/4 of the consumer debt. So whether times are good or times are bad, there are people who are living paycheck to paycheck. And when times are good, maybe the next jobs report says, 75,000 people got a job, but maybe you lost yours. So with the decrease in the price of gas, maybe take make hay while the sun is shining and take those savings and build up your emergency fund. And that applies whether times are good or bad.
Amanda.
Yeah, I mean, I couldn't disagree more with Jim, with all respect in the world. We need to take ownership. If there's a message that I would say, it's the two things. Oldest advice you've ever heard from anybody, pay yourself first. Find a way to put money away out of every paycheck before you even lay eyes on it. It works. It's something everybody needs to do. And the most important discipline around money is, remember, what you earn has to last you your entire life. So what you spend today, you're robbing your future self. There's no other way to think of it. We need to be thoughtful about that. There's only the one pool of money, and we all are living longer, so we need ownership.
All right, quick one-word answer on this one. We'll go quickly around the table. The one indicator you're going to be watching most this year, Patty.
In terms of the outlook for the Canadian economy, my favorite number is the outlook for the U.S. economy, because that's our best hope. A weaker dollar, stronger U.S. economy, that's the best medicine for Canada.
Jim.
Jobs. I started with jobs. I'll finish with jobs. We need to be churning out 25,000, 30,000 jobs a month pretty consistently in order to improve the situation.
Great.
I think to keep it simple, I would look as an economic indicator, because not a lot of people tend to spend a lot of time looking at economic indicators, maybe the Bank of Canada overnight rate. There are fears that if they raise the interest rates, this could destabilize the housing market. So if they do raise rates, they're maybe pretty confident that it's not going to.
Really good at one-word answer.
Wages. They've got to go up. They've got to stop stagnating. There's no sense in new jobs if we're not actually seeing wage growth. We need to see it.
All right. Good conversation. Thank you all, and thank
you.
you too. The bottom line, we'll be back in a month when Ottawa may be about to edge closer to its pre-election budget. Those are always fun. Patty, Jim, Preet, and Amanda will have their advice, I'm sure,